Are we in for a recession? Currently, talk of a recession remains all the rage. More people seem to be worried about a recession occurring. Lately, GDP growth for our economy was reported at 1.4% for the full financial year of 2019. And while we might not technically be in a recession, conditions have clearly been weaker. After accounting for our population growth, there's a net negative result in our GDP per capita. To help you understand what's happening in our economy, Ken Race and I are going to be conducting this think tank. We're going to show you data from the recent Reserve Bank's chart pack, as well as a number of graphs from CoreLogic, and we're going to explain what's going on. We're going to unpack those graphs. We're going to give you some commentary. So we're going to show you what's happening in our markets, and more importantly, give you some ideas about what's ahead. So welcome, Ken.
Thank you, Michael.
Now, for those of you who don't know Ken's my business partner and director of Metropole Wealth Advisory, but he's Australia's leading tax strategist. Ken specialises in giving strategic expert advice to property investors, to professionals, to business owners. And what I like about Ken's commentary is he's in a unique position to blend his skills of accounting, financial planning, wealth advisory, property investing, small business, to help you and our clients understand what's going on. Who's this think tank for? It's for anyone who's interested in our property markets, either as an investor or a home buyer, and particularly if you're a professional or in business, as our economy will affect you in many ways. And the benefit of this is, at the end of this session, you're going to have an unbiased understanding of what's happening in our economy and how it could affect you, your property markets or your home. Because, Ken, a lot of people are worried at the moment, aren't they?
They certainly are, and without making light of the situation of a recession, I think we're maybe playing into the hands of the doomsayers, because with a recession, it technically means you've had 2 quarters of negative growth. But having had 20 odd years of growth, if you have a small dip, it's really not the end of the world. And as we've seen over the last year at least, economic activity and growth has certainly slowed down, and we haven't fallen off the precipice. Things have got tighter, but it's not a life or death. And as this chart shows, there's a lifeline. The lifeline is everything else we own and do. So I'm cautious of the doomsayers talking of a recession, because I think they're talking down the economy, and that is one reason I think a lot of people aren't spending their tax cut, their interest rate cuts, because they're scared. So we've now got this plug in the economy that's arbitrarily being kept there by this talk of things maybe are going to not be so good in the near future.
Well, currently I'm finding that people are falling into 2 camps. Ken, the optimists, like you, like me, who see good times ahead. Maybe it's not great times. We recognise that there are some challenges, but there are some who actually at the other extreme who are even suggesting double-digit capital growth for our property markets on the back of falling tax cuts, on the back of falling interest rates, the bank's less stringent lending criteria. I'm not sure we're going to have a boom, but I'm feeling pretty positive. On the other hand, of course, there are the nervous Nellies. They're worried about the current weak Australian economy. They think it may lead to a recession. They're reading all those things on Google that takes them down the rabbit warren of all the concerns. And they think we're being fooled by our rising property values. They think they're about to crash and that we can't see what's going on. But as I said earlier on, Ken, I think that at times of change in the markets, we tend to get these mixed messages. Now, let me start by being frank. Australia's going to have a recession. One day. It will. But the government currently is hell-bent on us not having a recession. So it's not going to happen anytime soon. In the past, all recessions have occurred in Australia because of people like this gentleman on the screen at the moment, who's Dr. Phil Lowe, the Reserve Bank governor. And the recession we had in the early 1990s was caused by the government. You remember the Treasurer at the time said it was the recession we had to have because we had huge excesses. We had booming, not just property prices, but speculation in all areas. And earlier on, there'd been other recessions caused by the government to slow things down. today the government and the Reserve Bank are saying they're going to do anything to stop that happening, Ken.
That's right. And it's a two-sided coin. So the Reserve Bank works with interest rates, and the government works with tax. And the government can also stimulate the economy with government spending, as they're doing with infrastructure. So the Reserve Bank is really just one lever in this exercise. And they're bringing interest rates down to a point where they were hoping would stimulate the economy. And we're certainly the lowest interest rates Australia has ever seen. And there's talk of at least another one or two rate cuts by a lot of economists. But what we're seeing is those rate cuts haven't had the intended consequences of spurring spending. And that's because they're forgetting that it's confidence driven. And people aren't confident to spend. So what they're doing is they're paying down debt, which is a good thing. So Australia's got a very low, as one of the charts will show in the not too distant future, Australia's got a very low savings rate. So paying down debt is actually helping with our savings rate, which will give us money when the economy does turn, and we'll need it.
We will. So let's have a look at some of the most recent charts from the Reserve Bank. They bring these out once a month. And what this is showing is that the world's economies are slowing. And just recently, the International Monetary Fund suggested again that moving forward in the next 12 months, the world's economies are going to slow a bit, but there's no suggestion that overall we're going to have a worldwide recession, and our major trading partners, if anything, are performing a little bit better than the general world economy.
That's right, and we've certainly seen over the last 8 years, there's been a substantial gap between the growth rates of our trading partners and the rest of the world. And, that's because where we are and the things we do. So our trading partners want our education, our food, our raw materials. So it's good to actually be in this part of the world with our resources and ability to give the rest of the world what they want. So that's actually, if you like, giving us that better economic position in Australia than a lot of the other countries that we might say we're similar to, the G7, other European countries, the US, etc.
Now, we shouldn't take it for granted because things change and the world changes. And even though they are the countries closest to us, Southeast Asia, because where we're situated, if you actually put yourself in China, Europe's about as close to China as Australia is. So while China's close to us, there are other countries close to China or India. So we've got to actually take advantage of these opportunities and do the right things. So around the world, inflation is low, and that's one of the challenges Australia has got, that we're in a different economic time with low inflation, low interest rate, low economic growth. And there's lots of theories why this is happening, including artificial intelligence, robotics and offshoring, and more productiveness so that people don't have to do as much. So we probably are going to have to do things differently economically. The old theories don't seem to be working too well. So this is what's happening to Australia's GDP, which is a measure of Australia's growth. And the last one that came in, and it only comes in once a quarter, was reported as 1.4%, which if you multiply it out by 4 quarters would still be reasonable growth, but it's the trend down that I think is worrying some people, Ken.
Correct. And I think we've also got to be cognizant of the fact that most of the decision makers, if I can call them that, in Australia and around the world, haven't really lived through long periods of low interest rates and low inflation. So they don't know how to set the economic indicators of the returns they need to invest. They're basing it on old thinking, which had, interest rates 5, 6, 7%, inflation of 3%. So their targeted returns are arbitrarily high for the current economic conditions. So what we need is a rethink of what is going to be a good return on investment, given that we should see low inflation and low interest rates carrying on for quite a considerable period.
Sure. So when you and I first started investing many years ago and interest rates were double digit, if you had a home loan less than 10%, you were happy, and inflation was high, you had to get double digit capital growth or returns on your shares or in your business to have real returns. Today, a return with much lower figures is still going to give you a real return. So that's a good point. So this is actually what contributed to the GDP. In other words, there were only certain sectors of the market doing well, and that was, again, a potential concern that our economic growth recently has been in particular buoyed by exports and the government.
The government's ability to manage expenditure, particularly through infrastructure, particularly through buying their purchasing of different equipment, refurbishments of office accommodation, a little bit of spending on public housing. So the government can stimulate by spending money that they have control over. And the good thing about a lot of government expenditure is it actually uses a higher proportion of Australian goods and services and therefore labour.
The mining activity seems to have gone down with regard to investment because we have now built the mines. Now we're actually making money from the exports, as the previous graph showed. Ken, I read that even the trucks in the mining towns are being driven by people with joysticks back in Perth. It's not very labour intensive, but it's definitely bringing good income to the country and tax dollars to our government.
Correct. And so while the cost of that labour might be similar, the cost of retaining that labour, with travel, with accommodation, with meals, health and safety statistics are improving as well. So there's less wastage. So that's increasing productivity, which is helping our GDP growth in that particular sector. So they started off with long conveyor belts. They then went to big trucks, and now they're automating those trucks.
Inflation is low, and one of the things that the Reserve Bank wants to do is keep inflation between 2 and 3%, and you can see it's been a while since it's been that way. So they believe that if they can lower interest rates to stimulate spending, to stimulate wages growth, people are going to spend more and will pull inflation up. Now, I'm not even sure that it's right to try and get it to 2 and 3% when this hasn't worked elsewhere in the world. But I thought I'd just show what is in the Reserve Bank's mind, and it's in their mandate that they've got to try and increase inflation.
Yeah, and it's funny, the central banks have normally got the two areas they're looking at, employment statistics and inflation. And they've kept both those band requirements. Notwithstanding, we're seeing inflation dramatically lower than it's ever been. So I think they've really got to start looking at, do they need to now re-look at the target for inflation, given the world economy we live in at the moment?
I agree with that, definitely. And again, we're working through the monthly Reserve Bank chart packs to understand what's happening in Australia factually, as opposed to some of the myths that people are talking about. So this is a graph showing household savings ratio, and you mentioned that a little while ago, consumption and disposable income. And the concern is that wages growth hasn't moved, and on that basis, the savings ratio is starting to come down. One can see here that around 2008, 2009, we started saving more because of the concern of the global financial crisis, and so we started stashing our cash. Now we're eating into that a little bit. On the whole, we've got less disposable income, and therefore we're not consuming as much, which means another blow to the retail industry, which is having trouble with the online retailing as well.
Yeah, they're being attacked by multiple sides. Obviously, the online, I think buyers are looking for maybe different goods, and then the fact that people are saving as opposed to spending. But they're still spending. They're just, can I say, more savvy buyers. They don't have the same impromptu, I'll just buy it when I walk past it. And when they want to buy something, they're certainly looking at the price of that product and where is the cheapest source to buy that.
Well, Ken, I can assure you we're not having a recession because Pam and I went to Costco, our annual visit to Costco last weekend, and boy, were people filling up their big trolleys high, already buying their Christmas presents, already savvy shopping. So certain sectors of retailing are still doing well, but there's no doubt that people are being more careful. One of the things that's missing is consumer sentiment. We can see here it goes up, it goes down, it goes down, it goes up. It's definitely picked up, as one can see in this graph, after the election earlier this year. But all the news about the recession, the thoughts about a potential recession, it's not even a recession, all the negative news can almost be self-fulfilling.
Absolutely. The glass half full or half empty. And it's quite interesting. If you read the headlines, sentiment is being dampened because of economic talks, Brexit, the China-US trade, world economy, immigration, those sorts of things. It used to be, can I say, war that used to scare people. I don't think the world is any less precarious to having an outbreak of war than it was historically. But we have been in a fairly low risk environment for that to occur. And all the focus is now on the economy. That's why you were saying, I think earlier on, that this sort of presentation is for everyone so that they actually understand what is behind and they can debunk some of the headlines to what is really happening.
One of the other issues in Australia is now the lack of building approvals. Building approvals occur months, often years before buildings get built. And what this is showing is the green line, the high density housing, which we've been having a boom in up until recently. Building approvals are at very low levels. And that's a concern on a number of fronts. First of all, after the mining boom, a lot of people moved into high-rise construction, and so it kept workers busy, and it actually fueled industry because there was a whole lot of flow-on effects. But currently there's concerns about construction techniques, that overseas buyers have left the market, banks are not lending as easily for off-the-plan properties, and there's lots of good reasons why that's occurring. So there's going to be a shortage looming, but that always happens. There's the ups and the downs, and the next round of new construction is going to take quite some time before it takes off because of the stigma that has now overseen these high-rise towers. But with our population increasing in Australia by 400,000 people a year, we can't just build little one and two houses. We've got to build these larger complexes to be able to house them. So I can see a shortage of properties looming in the future. But this is an interesting graph that concerns some people, Ken. You can see how house prices have gone up, and you can see how household debt has gone up as well.
Yeah, and I think we need to break that household debt down into two components. There's the absolute dollar value of the debt, and then there's your ability to repay. So with interest rates so low, the actual out-of-pocket cost of maintaining that higher debt for a lot of people is less. So it's quite interesting when we're looking at who's spending money. We've got a group of the population who went through paying 17% interest rates when they were working, and they're now retired and getting the lowest interest rate for their money in the bank. So they're being hit at paying the highest interest rate and then receiving the lowest interest. That's certainly having a bit of an impact on that older generation spending money.
Of course, debt's only a problem if you can't repay it. And as you said, it's actually cheaper to repay now than ever. And that's reflected in the very, very low mortgage arrears and mortgage default rates. And there are certain pockets in Australia where mortgage defaults are higher, and they tend to be in regional Western Australia and Darwin, where property values have dropped the most and where there aren't many jobs. But in general, the debt is in good hands, the hands of wealthier, older Australians who can manage the debt. And this is a graph which shows how over the last couple of decades net wealth has increased, and that has increased for Australians because of, in general, their home. Of course, for those 2 million property investors, it's because of the other assets, the other properties they've owned as well. But also it's their superannuation and financial assets. So in general, Australians are wealthier. So overall, the liabilities have gone up, but the wealth has gone up more, Ken.
And that's because when people borrow, they borrow a higher proportion than the cash they put in. So that means they buy a bigger asset, and it's the whole asset that grows in value, whereas the debt stays stable. You know, if your property grows in value, the bank doesn't come and say, pay me more money. So historically, we had inflation keeping our debt levels relatively low because inflation effectively paid back the debt. Now with low inflation, that's not so much the case, but we have the benefit of being able to buy a bigger asset base. We just have to make sure that we've got safety nets in place to be able to repay the debt, and an exit strategy if something untoward occurs.
This graph shows housing credit growth. The figures are retrospective, and the ones that most recently came out are showing what happened around the time of the election, when in general people were a bit nervous and weren't taking on loans. But there were two elements to it. Banks were also much stricter with their lending criteria. So it shows that over time, credit growth has been much lower. And you can see here that investor lending has been the lowest it's been for a long time. And that's reflected in what we're finding in our clients, Ken. They're having difficulty getting loans, and they're not active in the as active in the market as they used to be.
Yeah, I think two things there. The government actually told the banks to lend less to investors and cap their growth. And we started to see a divergence in the interest rates that investors pay versus owner-occupier. So the investors pay more.
Business investment has also been poor over the last little while. So we're going to talk about some good things. We're actually giving some bad news, but we're actually giving that news as opposed to trying to push one side of the story or the other. And so there are good news bits in these graphs, and there's also some areas to be a little bit concerned. And let's be frank, the economy is not working as well as any of us would like. And that's one of the reasons why businesses are currently being a bit cautious as well. They're not taking on more inventory. They're not buying new equipment. They're waiting for a level of certainty.
Yeah, and as that graph shows, we do have cycles. I mean, the sun rises after the night. So people should, I think, not forget that. It's just being able to live through that period of darkness. And even that chart shows that back in the late 80s, there was quite a significant reduction in business activity. But there's been a couple, but there's a pickup. And that's because the economy eventually says we need to start working again.
You're right. After every winter, spring comes. It's come from time immemorial. I'm prepared to put my money on that after this winter of the economy, spring is going to come around again, as it has in the property cycle as well. So this is just another graph showing business sentiment and business conditions, and there is room for businesses to employ more people, buy more equipment, and the opportunity for the government to encourage businesses there. Call me cynical, Ken, but I think they're wanting to get this big surplus first and come out next budget and say, look how good we are. We're the first government to have a surplus. So they could be spending, greasing the wheels of industries now, but they're not going to do that till they can show off. And maybe closer to the election, it may all of a sudden be that they can encourage business to start spending again. Now, this graph shows unemployment, which varies from state to state. Overall, in Australia, unemployment is still relatively low. It's crept up a little bit. The Reserve Bank says it's going to keep dropping interest rates till employment growth picks up. But the problem at the moment, Ken, is the participation rate. More people are back into the workforce again because maybe their savings isn't as much there. So there's more of us having jobs at the moment.
Correct. And so there's more people with a job, and there's a higher proportion of people with a job but not working the hours that they would have liked.
I read recently that if you add underemployment and unemployment together. It's over 13% of the population or the workforce at the moment. So there is definitely scope for more work. And one of the things with regard to property is if people have got a job and if they've got high disposable income, they can push up the value of properties more. And that's why we were very careful about choosing locations where employment is more full-time rather than part-time work. So a lot of people say, go buy in regional Australia, go buy properties because there's jobs all over Australia, not just in the big capital cities. But I've found that there's more seasonal, more casual, more part-time jobs in those areas. So I like to look at areas where there's higher paying jobs. So what we've shown you so far is a number of the Reserve Bank charts that they bring out every month to give you an understanding of what's going on. But I think probably more importantly is what's ahead. Now, the Reserve Bank does a number of forecasts as well, and they're suggesting that our economic growth is going to pick up over the next couple of years. They're suggesting that inflation is so slowly going to pick up, and they're doing everything in their power to do that. And they've got more things up their sleeve, not just dropping interest rates, but there are other economic measures, quantitative easing, and there's also the ability for the government to spend more. And the unemployment rate is likely to drop a little bit more. That's what the Reserve Bank forecasts are suggesting. But let's have a look at some good news, because there is a lot of good news that sometimes gets lost amongst all the headlines. So one of the first things is that the Reserve Bank and the government do not want us to go into recession. They're going to do whatever they can, and there are a number of measures because they don't want to be seen as the first government in 22 years to allow Australia to get into recession. So I believe that they're going to pull out all stops. The other is that our property markets are starting to pick up at the moment. Now, Melbourne and Sydney in particular, because Melbourne and Sydney had the biggest drops. But when that happens, one has more of a wealth effect. So over the last little while, as property values, particularly again in Sydney and Melbourne, dropped, people felt a bit poorer. Not that they were selling their homes. And a lot of it has to do with consumer sentiment. When they feel their houses are going up in value, they feel a little bit better, Ken.
That's right. And if you see the headline rates every weekend, 80, 90% auction clearance rates, property prices are increasing another 2%. You feel good that in a worst case scenario, you've got a high valued asset.
Australia's population growth is one of the things that's underpinning our economy. So how do you make an economy more productive? One is by being more productive, like you said a bit earlier on, Ken, in how you manufacture things, how you do things, how you produce things. But the other is to actually put more people into the economy. So the discussion about a big Australia, small Australia is now long gone. We're fiddling around the edges a bit, saying we're going to lower migration a bit. But of the 400,000 population growth in Australia, 60% is migration, and the majority of those are in household formation age, and they're coming with the ability to work for jobs, and so that's underpinning Australia's economy as well. And we mentioned a couple of times, Ken, infrastructure spending is one of the ways the government is helping grease the wheels of industry.
Because infrastructure uses predominantly Australian raw materials, the sand, the rocks to make the concrete, the steel and the labour. And the other thing too with migration that we were just talking about, we shouldn't forget that we have a very ageing population. So we need that migration to come in to generate economic wealth, jobs, pay taxes to support the ageing population.
So while people believe Australia's population is ageing, and in general we are, I recently read that there's more people born after 1980 now than there were before, because we are bringing this mix of young people in that are helping make Australia's economy vibrant. Interestingly, the low Australian dollar is supporting our economy by aiding Australian businesses that compete internationally, and the floating nature of the Australian dollar wasn't around when we had the last election, so it's a bit of a shock absorber, Ken.
That's right. So with the lower exchange rate, we can actually export more cheaply. The higher the exchange rate, we import cheaper. So one of the reasons the Reserve Bank has, if you like, kept pushing down interest rates It's because they wanted to match the rest of the world so that our exchange rate wouldn't arbitrarily increase to make it dearer to export. Currently, we are an export nation, minerals, education, food. So we need that lower exchange rate to make it more competitive to export, which is why the government or the Reserve Bank kept pushing interest rates down in line with the rest of the world.
Now, we've spoken about it before, but it's likely that there's going to be a budget surplus in 2019, 2020. It's suggested it could be around 0.5% of GDP. And in general, the government debt level is reasonably low. So there's plenty of room for the government to introduce fiscal stimulus to actually spend more money. As I said, I think that's going to be coming, but maybe not until the next budget, until they've had their day in the sun. But there's a number of industries that are doing well. We've already spoken about that. There's the exports. And with exports, we tend to think about the mining, but there's all the food. We could well be the food bowl of Asia if we play our cards right. And there's the education. That's a huge export industry.
It helps underpin, if you like, the education of the local population because it spreads those fixed costs. The other one, of course, is health. So Australia is certainly seen as a leader in health services, and we export that by people coming here for various procedures and by training, again, sometimes through the universities.
And of course, tourism is a great industry as well, bringing dollars in. And with the Asian countries building a great new middle class of people who want to travel, if we play our cards right, we're going to be where they want to travel to, and that's going to bring dollars in supporting our economy. One of the things that's missing is consumer confidence, and it's being beaten every time there's the R word in the media or there's concerns. So I'm disappointed when the media keeps giving negative messages when they forget all these good things we said. So that's part of the reason that we've spent the last little while explaining to you some of the good things that are occurring. So let's have a quick look at what's happening now to our housing markets, because there is some good news in the housing markets. And these are the most recent figures from CoreLogic at the end of September, showing over the last quarter, the Melbourne and Sydney property markets have increased around 3.5% each. If you annualize that, that's double-digit growth. I don't expect that to occur. I think realistically, it's going to probably go up less than that over the next year. But again, that's very segmented. It's a bit like putting one in a bucket of hot water and another in a bucket of cold water. In Melbourne and Sydney, we know it, and in Brisbane also, where we know the markets intimately, there are some areas that are really hot with a huge undersupply of properties, and there's some areas that are pretty cold and they can't move properties at any price. So correct property selection is important. This is suggesting the nature of our property markets, how they move up and how they move down and what's going on. Understand that we're at a great time now counter-cyclically in Sydney and Melbourne that have had the biggest dips that are now increasing, and to ride the continuing wave in the Brisbane property markets where property values are increasing. Interestingly, the markets are picking up at the higher end. The most expensive dwellings recorded the largest declines, but now they're also showing the areas of rapid recovery. And it's always that way. It starts from the more expensive areas and ripples out, and it may be quite a number of years before the outer lying suburbs of our capital cities that did well during the lower interest rate environment are going to pick up again. It'll be some time before they pick up, because now the low interest rates have worked their way through. People can't afford to pay more. Their wages are not going up. So you've really got to invest, in my mind, in those areas where wages are increasing, where disposable incomes are increasing. And this is showing that today property values in Sydney and Melbourne are still below their peak. So if you're buying today, even though you've missed the bottom of the cycle, there's still reasonable upside there.
Upside. And look, I think it's like when they talk in the stock market, when times are tough, there's a flight to quality. So I think in the housing market, you should be buying quality because low inflation, low interest rates, it's a little bit more difficult to borrow. So you have to make that investment decision count in the shortest possible period, which requires you to buy that investment grade property that can outperform the market. It's absolutely critical to make that dollar work as hard for you as possible.
That's a really good point, Ken, because during the booms, everything sells on the main road, wrong location, the wrong aspect, having bad neighbours because of the FOMO, the fear of missing out. But when the market turned down, they're the properties that lost their most value in certain locations, certain suburbs and certain types of property held their value. And that's the only sort of properties that you should be holding on to. We've already explained that housing credit is at historic lows. And so that's one of the things that's going to slow the property markets. So even though the market has picked up, as I said again, particularly in Melbourne and Sydney, I think it's a difficulty getting credit, difficulty getting finance. And on that basis, I can't see double-digit growth occurring for some time yet. And it'll probably take another year or 18 months for Melbourne and Sydney to reach their historic peaks. And from then on, it's all the way up again.
That's it. So it's really, do you want to be part of that average, which means you'll have to wait that long, or selective buying gets you there a bit sooner with less risk?
And of course, if you can manufacture capital growth through renovations and development, increasing your rents, increasing your capital asset base, that's a great way of beating this low inflationary cycle. This is another graph just showing how investor activity has faded over the last couple of years. And it's not for a want of trying. Investors are still keen to get in. They just can't get the finance. So what's ahead? In my mind, we're still going to have a period of cautious lending. We're going to have a period of low inflation. We're going to have a period of lower wages growth. And I see major changes to our workplace where there's going to be fewer well-paid jobs, and the average worker is going to be competing with robots, artificial intelligence, offshoring. So we've got to find areas where wages go up more than average, where disposable income goes up more than average, because they're areas where people are going to be able to pay more for their properties. Otherwise, property values won't increase. I also see that if this cycle is like every other cycle, a lot of property investors are going to fail. Really interestingly, there's 2 million property investors in Australia. 1.8 million of those own one property, never get past their second. Some get to a second property. Most never get past that. There's 23,000 who own 6 or more properties. 1.8 million, 23,000. There's a reason why a small group get a substantial asset base and the majority don't. And you have to do what that small group does and not listen to who the majority of people listen to. So what's the best strategy for this stage of the cycle? Buy high growth, capital growth properties in our capital cities, in locations that are going to outperform the averages. I know some people say invest for cash flow, but in my mind, your job is to build an asset base, because I don't know what the future is going to hold for you, for the government, whether you're going to be able to have a pension, whether superannuation is going to be able to be borrowed against, what the tax regime is. What I do know is if you have a big asset base, you will have choices. And if you don't have a big asset base, your choices will be limited. So you've got to work through the following stages of your investment journey. Number one, accumulate assets. Then slowly lower your loan to value ratios. And you've got to wait 10, 15, 20 years, sometimes even longer, to build a big asset base. Then you slowly lower your loan to value ratios, and only then can you invest for cash flow or live off your cash flow or enjoy your golden years through your cash flow. It's got to be done in the right order. If you don't do it in that order, you're in trouble. You've heard us talk about it before, but we believe that location does 80% of the heavy lifting. We only invest in capital cities because that's where the bulk of economic growth is, jobs growth and wages growth. It all has to do with wages growth and where people's incomes are going to be higher to be able to support pushing up property values. Then within those suburbs, we choose the right location. We like suburbs with a large percentage of owner-occupiers who are going to underpin the property markets. We like suburbs where infrastructure is going to be of assistance. We look where the right supply and demand ratio is. We look for areas where there's an affluent demographic. And then within those areas, we look for convenience, for a good walk score, for good public transport, for good amenity. And then you've got to buy an investment grade property within that location, one with owner-occupier appeal, one with a level of scarcity, one with a high land to asset ratio. Doesn't mean you can't buy apartments or townhouses. We think they make great investments in the right areas. Something with a twist, something with the ability to add value. We like that. And so therefore choosing the right property, as Ken suggested a minute ago, is important. It's critical. But you've got to be careful because most investors are not going to be successful. And why can I say that? The statistics just show that is the case. So part of our job at Metropole is to actually stop people from making mistakes, protect investors from themselves, give them unbiased advice.
I think it comes down to you invest, you don't speculate.
That's a really, really good point because a lot of people think they're investing, but they're actually speculating. So now you've got a choice. Why did you spend the last hour or so listening to Ken and me? You're looking to secure your future. And as far as I see, you've actually got three options. One is you could do nothing. And can I tell you, that's what the majority of people that we come across do. The other is you can try and do it yourself. Gee, that's hard. It's hard to do it. You're going to pay a huge learning fee to the market. Over the years, I know you have, Ken, as well. So part of our job is to protect our clients from that learning fee. Or the third way is to allow the team at Metropole to help you. And at Metropole, we help our clients grow, protect, and pass on their wealth because we believe in this more difficult environment. You need more than a buyer's agent to help you move forward. You need more than a property strategist. You need a holistic approach to your wealth. And that's why at Metropole, we have a financial planning arm that Ken runs. We have a wealth advisory division. We have constructions and renovations. We manage close to $2 billion worth of assets for our clients through our property management department. So don't you think we know what makes a good asset and what doesn't when we have that information? We have a buyer's agency. We produce strategic wealth advice. Ken does very detailed wealth plans for clients. Our property strategists do very detailed strategic property plans, and they all link together with a holistic approach with your property strategist looking after you, building a long-term partnership. If you're interested in taking your investments to the next level, if you're not sure who to trust, why not have a chat with the team at Metropole that have won multiple awards, that have been involved in over $3 billion worth of property transactions, that currently have our own teams on the ground, so we don't fly in and fly out in the biggest capital cities of Australia. We're happy to be part of your wealth creation journey. Go to metropole.com.au, find out about us, leave us your details, and we'd love to be part of your wealth creation journey. Have a chat, find out what your options are. Have the first chat's obligation free, and if you are a business person, a professional, or definitely if you're in the high net wealth category, why not let Ken Race give you strategic wealth advice, estate planning advice? Again, go to metropole.com.au. You'll find out a lot more about what we do. Ken, thank you for spending the last hour or so with us. You've given us some great insights.
Thank you, Michael.